Everyone keeps asking the same question. Is this another 2000?
The truth is, it's not just 2000.
This market has 2000 level valuations, 1970 level concentration,
and a 2020-style Fed reaction function.
If you rely on old warning signals, you'll be late.
If you ignore them, you'll be trapped.
Let's break down why this cycle is different and why it's still dangerous.
Welcome back to the Deep Dive. It is February 3rd, 2026. And I have to be honest with you, I feel like I'm taking crazy pills when I look at the news today.
You are definitely not alone in that feeling.
I mean, let's just look at the board. The S&P 500 is, flirting with 7,000? It's an all-time record high. Corporate earnings are absolutely booming.
They are.
But then I talk to my neighbors or I look at the data, and consumer confidence has just plummeted to a decade low. It's a massive paradox. It's like we're living in two different realities simultaneously.
It is a striking divergence. Usually when the stock market is partying this hard, the average person feels at least okay. But right now, the disconnect is wider than we've ever seen.
Exactly. It feels like the dashboard of the economy is completely broken. For years, economists have told us to watch for the warning signs, the check engine lights. But honestly, the check engine analogy feels too old school for this. It feels more like we're in a high-end electric vehicle. The sensors are screaming that there's an obstacle ahead. The emergency braking system should be kicking in. But the software, the central computer, just decided to override everything and accelerate.
That is a much, much more accurate metaphor. The traditional mechanical signals are flashing red, but the car is spatting up.
So that is the question we are tackling today. Are the signals actually broken? Did we rewire the car? Or is this delay just building up momentum for a much bigger crash?
Well, to answer that, we have to look under the hood. We've got a really interesting stack of sources today. We have a structural market analysis that explains why those old signals are misfiring.
Yeah.
We have the latest hard numbers from FactSet for Q4 2025 earnings. We also have breaking news on the Federal Reserve nomination, which is a huge variable, and the IMF's January 2026 World Economic Outlook to give us the global map.
So what is the mission here? Are we just trying to, predict the crash?
The mission is to unpack why this time is different until suddenly it isn't. We need to identify the foreign objects clogging up the economic machinery and define exactly what kind of financial bubble we are actually living in. Because make no mistake, we are in a bubble. It just might not be the kind you think it is.
Okay, let's get into the machinery. I want to start with that broken dashboard. For as long as I've been following finance, the golden rule has been the yield curve. Specifically the 2-year and 10-year Treasury yields. When short-term rates are higher than long-term rates, an inversion, it means a recession is coming, period. It's been 100% accurate historically.
It has.
It's been inverted for, years now? Why hasn't the sky fallen?
This is where we have to look at the plumbing of the financial system. The analysis suggests the signal wasn't wrong, it just predicted the wrong thing.
What do you mean?
Historically, an inverted yield curve destroys bank profits. Banks borrow short and lend long. When the curve inverts, that business model breaks. They stop lending, credit dries up, and the economy crashes. And you know what? That part actually happened.
The banks slowed down.
Bank profits were compressed, traditional lending slowed way down.
But the economy didn't crash. So where did the money come from? If the banks closed the tap, who kept watering the garden?
The garden found a new water source. Since COVID, we've seen the rise of a massive force that has effectively rewired the economy. Private credit or shadow banking.
Shadow banking always sounds so nefarious, like guys in trench coats meeting in alleyways.
It's a less trench coats and more private equity firms in Midtown Manhattan. But here's the mechanic of it. Let's say you are a mid-sized software company and you need $50 million to expand.
Okay.
You go to your regional bank. The bank looks at the yield curve, looks at the regulations, and says, sorry, we can't take the risk right now. In 2008, that company would have fired people and shrunk. Recession starts.
Right. Game over.
But in 2025 and 2026, that company goes to a private credit fund. Blackstone, Apollo, Ares, take your pick. These funds have raised hundreds of billions of dollars from investors. They say, sure, we'll lend you the $50 million. The interest rate will be higher, maybe 12% or 13%, but you get the cash.
So the economy bypassed the banks entirely.
Exactly. The main highway of bank lending was closed, just like the yield curve predicted. But everyone just took the scenic route through private credit and kept driving. The yield curve signals banking stress, but it doesn't account for this massive shadow system that keeps liquidity flowing.
That sounds convenient, but is it sustainable? If we're bypassing the safety checks of traditional banks, who have regulators breathing down their necks, aren't we just building up risk somewhere we can't see? I mean, who regulates the shadow banks?
That is the multi-trillion-dollar question. They are far less regulated. And the risk is that if that market freezes, if the private lenders get spooked, there is no Federal Reserve backstop for them. But for now, it explains why the recession hasn't arrived on schedule.
Okay, so the credit signal was bypassed. What about the other big one? Unemployment. The rule is usually economy slows, companies fire people, people stop spending, economy collapses. But we have this weird dynamic where everyone seems to have a job, but everyone is miserable.
This is the structural labor shortage.
Yeah.
We aren't just in a normal business cycle. We are dealing with demographics. The baby boomers have retired. Immigration flows have changed. There simply aren't enough workers.
So companies are scared to fire anyone.
They are terrified of it. It's called labor hoarding. Imagine you run a logistics company. Business is down 10%. In the old days, you'd lay off 10% of your staff to protect your margins.
Like, first thing you do.
But now you know that if you fire those drivers or warehouse workers, you might never get them back when business picks up. So you eat the cost, you keep them on the payroll, even if they aren't fully utilized.
Which breaks the signal. Unemployment becomes a lagging indicator. It doesn't warn us of trouble. It only spikes after the company has completely run out of cash.
Precisely. By the time you see layoffs in the headlines, the company is already on its deathbed.
But here's the part I struggle with. If companies are hoarding workers, that means people have jobs. If people have jobs, they have income. So why is the Consumer Confidence Index at 84.5? That is recession-level gloom. Why is everyone so unhappy if they're employed?
Because having a job and feeling wealthy are two different things. Inflation has cumulative effects. Yes, you have a paycheck, but the cost of housing, insurance, and food has risen faster than that paycheck for 3 years. People are employed, but they feel poorer.
The vibes are bad because the math is bad at the kitchen table. But, and this brings us back to the paradox, if the consumer is tapped out and gloomy, why hasn't the bubble popped? Usually when people stop buying stuff, the market crashes.
Yeah.
Why is the S&P at 7,000?
This is the most critical distinction to understand about 2026. We are in an investment-driven bubble, not a consumption-driven bubble.
Break that down for me.
Think about the 2008 housing crash. That was consumption. It relied on regular people buying houses. When they couldn't afford the mortgage, the whole thing collapsed. But this bubble, this is the AI bubble. It is driven by corporate capital expenditure capex.
So big tech buying chips.
Right. It doesn't matter if you, the listener, feel too broke to buy a new iPhone this year. That doesn't stop Meta or Microsoft from spending $50 billion on H100 clusters and data centers. The spending driving the economy right now is business-to-business infrastructure spending. It is completely decoupled from the consumer's mood.
So the stock market is essentially saying, we don't care about you right now. We are building the future, and we are paying cash.
For now, yes. The consumer is a spectator in this part of the rally.
That is slightly disturbing. It makes the market feel like a runaway train that we're just watching from the platform. But if this is a bubble, I need to know what kind of monster we are dealing with. Is this 1929? Is it the dot-com crash of 2000?
The analysis calls it a Frankenstein market. It's a monster stitched together from the most dangerous parts of 3 different eras.
I love a good monster movie. Let's see the parts.
Okay. The head of the monster is the valuations of 2000. We have incredibly high price-to-earnings ratios. But specifically, we are seeing the return of vendor finance.
Vendor finance. I've heard that term thrown around. Explain it like I'm 5. Or maybe like I'm an investor who doesn't want to lose my shirt.
Okay. Imagine I sell lemonade stands. I want to show the world that my sales are booming, but nobody has the cash to buy my stands. So I lend you the money to buy a stand from me. I record the sale as revenue. You owe me the money.
So bought it with your money.
Exactly. In the dot-com era, companies like Cisco and Lucent did this. They lent money to telecom startups to buy their equipment. It looked like massive growth until the startups went bust and couldn't pay back the loans. Then the revenue disappeared and the cash was gone.
And we're seeing that in AI.
There are signs of it. Large tech companies investing in smaller AI startups who then turn around and use that investment to buy cloud credits or chips from the large tech company. It creates a circular revenue stream. It's not illegal, but it creates a fragility. If the startup fails, that revenue evaporates instantly.
Okay, that's the head of the monster. What's the body?
The concentration of the 1970s, the nifty 50 era. Back then, investors piled into just 51 decision stocks that could never go down. Today, it's even narrower. It's the Mag 7, or really the AI 5. The entire market's performance is holding on the shoulders of a handful of companies.
And the third part?
The legs. The policy reaction of 2020. The Fed put. The psychological belief ingrained in every trader that if things get really bad, the government will print money to save us.
So we have the circular financing of 2000, the narrow market of the 70s, and the daddy will save us psychology of COVID. That is a volatile mix. But I have to play devil's advocate here. In 2000, those pets.com companies were jokes. They had no profits. I'm looking at the FactSet data you sent over. These AI companies are printing money.
You are absolutely right. The fundamentals are vastly superior to 2000. Look at the FactSet earnings insight for Q4 2025. The S&P 500 isn't just hoping for profits. They have blended earnings growth of 11.9%.
11.9%.
That's 5 quarters in a row of double-digit growth. And the kicker, net profit margins are at 13.2%.
13.2%.
That is the highest margin since FactSet started tracking it in 2009. These companies are incredibly efficient money-printing machines.
So if they're making money, why is it a bubble? Why isn't this just success?
Because of time compression?
Time compression.
That sounds like sci-fi. It feels like it. The market has priced in the next 10 years of perfect AI execution into the last 24 months' stock gains. Investors are paying today for the profits of 2035.
So even if the companies do well, the stock might not go up because the price already assumes they'll do perfectly.
Exactly. If a company grows 20%, which is amazing, but the stock price assumes 50% growth, the stock crashes. The fundamentals are real, but the expectations are delusional.
That brings us to the present moment. We've got this delicate setup, and now we throw politics into the mix. We have to talk about the news regarding President Trump and the Fed.
The political variable. Breaking news. Trump is preparing to nominate Kevin Warsh as the next Fed chair.
And the market reaction was weird, right? I saw bond yields jump. The 10-year Treasury hit 4.29%. Usually, if a Republican nominates a chair, the market expects business-friendly policies. Why the spike in yields?
This is where the nuance of monetary policy gets tricky. Warsh is known as a serious hard money guy. He might support cutting interest rates, which Trump wants, but he is very hawkish on the balance sheet.
Okay, we need to unpack balance sheet. When the Fed buys bonds, they inject cash into the system. That's the balance sheet expanding. Warsh wants to do the opposite.
Correct. He believes the Fed holds too much debt. He wants to shrink the balance sheet, let those bonds roll off. That pulls liquidity out of the system. It's like draining the oil from the engine.
So even if he lowers the interest rate, he's removing the cash that lubricates the trades.
Exactly, and that stares the bond market. If the biggest buyer of bonds, the Fed, steps away, who buys the debt? The yield has to go up to attract other buyers. That's why we saw that 4.29% spike.
And looking at the stocks, it caused a rotation. Apple was up 4%, but the AI darlings NVIDIA, Meta took a hit. NVIDIA down almost 3%. Why would Warsh hurt NVIDIA but help Apple?
It's a flight to safety within the tech sector. If liquidity is going to get tighter, investors get nervous about those sky-high valuations we talked about. They start thinking, maybe I should take my profit on the high-risk AI trade and park it somewhere safer, like Apple, which basically acts like a bank vault.
It connects back to that IMF report too, doesn't it?
It does. The IMF's January report explicitly warned that if AI productivity doesn't show up fast, there will be a repricing. With Warsh potentially tightening the liquidity, that repricing could happen sooner rather than later.
Speaking of the IMF, it wasn't all doom and gloom. They actually upgraded the U.S. growth forecast to 2.4% and China to 4.5%.
That's largely due to the trade truce. The cooling of tensions between the U.S. and China has taken a massive weight off global trade. And there's one other savior for the consumer right now: oil.
$62 a barrel.
Cheap energy is the only thing keeping the consumer from totally cracking. It's a direct tax cut. If gas were $4 a gallon right now, with these confidence numbers, we might already be in a recession.
So let's try to see the future here. We have a Frankenstein market, a broken dashboard, and a new Fed chair who wants to drain the pool. If the usual signals don't work, what are the triggers? How do we know when the party ends?
Our analysis points to 3 specific trigger conditions: Since we can't trust the yield curve, watch these. The first is ROI failure.
Return on investment.
This is the AI-specific trigger. We are spending hundreds of billions on chips. Eventually, companies need to say, hey, this AI bot actually saved us money, or it created a new product that sold.
Yeah, and if they can't prove it,
Then the CapEx spending stops. And if Amazon and Microsoft stop buying chips, NVIDIA crashes and the whole index comes down with it.
okay. Trigger 1 is the tech not paying off. Trigger 2.
A credit freeze. This goes back to your shadow banks. This isn't about the Fed raising rates. It's about the private credit market suddenly getting scared. If a few big private loans go bad, these unregulated lenders might just pull back.
And since they are now the main source of water for the garden,
If they turn off the hose, things die fast.
and the third,
A Fed reversal. We all expect rate cuts, but we just had a hot PPI, print producer price index, up 0.5%. If inflation flares up again, the Fed might say, sorry, no cuts.
that would pull the rug out from under the valuations.
Completely.
So let's say one of these happens. What does the crash look like?
Mhm.
Are we talking 2008 people walking out with cardboard boxes, banks failing?
The consensus seems to be no. The banks are better capitalized. This likely won't be an explosion. It will be a grind. The analysis predicts a mix of the 1973 and 2000 crashes.
That sounds miserable. What does a grind feel like?
It feels like the lost decade. The stock market might not drop 50% in a week. Instead, it might just go sideways. For years. Sideways.
Imagine buying the S&P at 7,000, and 5 years later, it's at 7,100. You haven't lost money nominally, but inflation has eaten 15% of your purchasing power. The market corrects through time, not price. Earnings slowly catch up to the high stock prices, but investors make zero real return for a long time.
It's the slow erosion of wealth. And I assume if the market just goes sideways, the Fed isn't going to rush in to save us.
That is the most important takeaway. The Fed reaction function has changed. In 2008 or 2020, the Fed saved asset prices. They pumped up stocks to make people feel wealthy. But now, their priority is system stability. Meaning, as long as the ATMs work and the checks clear and the banks don't collapse, the Fed doesn't care if your stock portfolio drops 20%.
They will save the payment system, but they won't save the NASDAQ.
Exactly. They are done with the Fed put for stocks. The market just hasn't realized it yet.
That is a lot to process. It feels like we are walking on thin ice, but everyone is dancing because the music is so loud.
That's a good way to put it. So let's recap this investigation. The old signals like the yield curve failed because the economy rewired itself around the banks via private credit. Unemployment is misleading because companies are hoarding labor to avoid future shortages.
Right.
We are in a massive investment bubble driven by corporate spending, completely detached from the gloomy consumer. And while corporate profits are real and record-breaking, we have priced in perfection for a decade.
That is the summary. The danger isn't the apocalypse. The danger is that the future returns have already been eaten by today's prices.
It's like we ate the dessert before the main course, and now we have to sit through a very long, boring
We're
dinner.
going to pay the bill at the end.
I want to leave the listener with one final thought you mentioned in the pre-show. It's about that divergence.
Yes. We have this solid economy on paper GDP, earnings, and a miserable consumer in reality. Right now, the AI boom is holding up the economy on its own. It's defying gravity. But the provocative question is this. Can the robots keep the economy growing if the humans are too broke to participate?
If we stop buying the products, does the AI eventually hit a wall?
Ultimately, all economic value comes from a human buying something. If the consumer breaks, can the real economy act as an anchor that drags these sky-high valuations back down to earth? History says yes. The market says not yet.
Well, on that uncertain note, I'm going to go check my portfolio and maybe hide under the bed. Thanks for unpacking the monster with us.
Today, curious.
AI-assisted analysis and illustrative visuals. Educational content only, not investment advice.